What's going on, everybody? Russ Ivy here for another personal finance video for you. And today I'm really excited because I'm going to cover a subject that I haven't discussed before. You see, prior I've done videos and I've done one-on-one sessions with people and I've done Teams calls to talk about Velocity Banking, which is a debt management system that helps you knock out your debt in a fraction of the time. And I continue to teach that on a regular basis, and I'm happy to go over that with you if it is something you want to talk about. But today, I'm going to cover something new, not really new, but it's new in my world, and it is about privatized banking, which is something that you may have heard of and maybe always thought that it wasn't something that you could accomplish. Well, today I'm going to talk about what it is. I'm going to demonstrate how we're using it in our lives, as well as I'm going to show you that in the middle of this presentation, I'm going to show you how you will be able to recapture every single dollar that you ever spend on another car moving forward if you implement this system. So what I'm going to do right now is share my screen, and we are going to discuss what we're talking about today. So we are going to discuss what is called the infinite banking concept. Now, what this is it is a type of privatized banking. But before I get into that, I want to bring up one thing, and that is a disclaimer. Okay. I like to do this on all of my videos and any of my discussions with people. I am not a tax attorney. I'm not a certified financial planner. I'm not a certified I'm not a CPA or a registered investment advisor. I'm merely sharing my experience and my knowledge of infinite banking with you. So take this video as entertainment. And if you feel it is something that you would like to try, I highly recommend that you speak with your own financial advisors to see if it may be a good fit for you. Now, I want to start by showing you a quote here, and this is by a gentleman by the name of R. Nelson Nash. Now, R. Nelson Nash was the man who many people who do infinite banking refer to him as basically the founder of infinite banking. He's kind of like the godfather of it, even though it is something that has been going on for a couple of hundred years actually. But what he did in the 1990s is he figured out a way that it could be used by people such as ourselves, the middle class. And he figured out how to do that. And one quote that he has said is that you finance everything you buy. You either pay interest to someone else or you give up interest that you could have earned elsewhere. So what does he mean by that? What he's basically saying is that anytime you make a cash transaction or a finance transaction, when you purchase something, you are literally paying interest. And that could be either through the use of a credit card, it could be through doing a loan, it could be through personal financing with the company that you're purchasing something from. And even when you pay cash, you pay interest. And why is that? That is because if you were to take your money out of a bank account that was earning interest in say a savings account, if you take that cash out to buy something, you have now lost the growth that money would have made had you left it in the account. So effectively, you're paying interest no matter what you do when you make a transaction to purchase something. So R. Nelson Nash covers that. And if you want to read up about his concept of infinite banking, he wrote a book called Becoming Your Own Banker. And I urge you to look it up because it's a very good book. It's an easy read, and it is something that I find that I found very interesting and was highly informative. So let's start by giving you what I call the vacation dilemma. I'm going to give you a situation, and I'm going to have you think this through. Okay. Now, let's say that you have decided that you'd like to go on vacation, and You found this tropical island and you want to go to this tropical island, and you've determined that it's going to cost you $10,000 to go on this vacation to this island. And it just so happens that you have $10,000 sitting in your bank account at the bank. And in that savings account, it is earning 4% interest, right? And so what you decide to do is you decide to go down to the bank and you get in line with the teller line, and you get up to the teller and you explain, "Hi, I'm so and so. I would like to withdraw my $10,000 out of my savings account." Well, let's say that I am the bank manager and I happen to overhear this conversation, and I come up to you and I say, "Well, hang on a minute, sir or madam. Um, why don't we do this? Why don't you keep your $10,000 in your savings account? And what we will do is we will loan you $10,000 over a 3-year period, and you can pay us back at 6% interest. And that way you can keep your money and it can keep earning, and you just pay us back over 3 years." So here's my question for you. All right. Would it be smart for you to leave your money sitting in your savings account for 3 years, earning 4% interest, while taking a loan from me at 6% interest to pay that $10,000 back? Would I make more money than you would make with your money sitting in the savings account over the same period of time? Now, I would think that most of you would say that no way, there is no way that I would make more money than the bank would, because the bank is charging 6% interest and I'm only earning 4% interest. And yeah, over 3 years, that doesn't make any sense. That they're going to make more money. So I've done the math. So let's take a look here. So over 3 years, you will have paid back to the bank $10,951.90 over 3 years at 6% interest. Meanwhile, over 3 years, your $10,000 at 4% interest in your savings account has grown to $11,248.64. That's weird. Why is that? That that doesn't seem right. Well, here's the reason why. It is because when your money is sitting in your savings account, it is compounding, and it is compounding interest, right? So there, one account is going up and another account is going down as you're paying the loan off. So as the loan is getting paid off, you're paying less and less interest. Meanwhile, in your savings account, your money is growing exponentially. And that is why a 4% interest rate in a savings account will surpass a 6% interest rate on a loan any day of the week over time, because of the fact of compounding interest. I'd like for you to keep that in your brains as we move forward, because that's going to play a big part down the road when we get into infinite banking and how it works. So now I'd like to switch gears. I'm going to talk to you about what's called the bank spread. Okay? So basically, let's say that you have some money and you've decided to deposit it into a savings account at the bank. Now, the bank has agreed to pay you an interest rate. Let's say this is a really good savings account. Maybe it's a high yield savings account. And the bank has decided that they're going to pay you 4% interest on your money as it sits in the account. Okay. Now, when you put your money into the bank, do you think that they take your money and they go to the vault and they stick it in the vault and they leave it there until you need to get your money back? Well, of course not. No. Banks use your money and they continually use your money. For example, they're going to take your money immediately whenever they receive it, and they're going to loan it out, because on their books, they actually make your money a liability on the books, not an asset. It is a liability because they have to pay you interest. So where they turn it into an asset is by loaning it out. For example, they may loan it out to someone who wants to buy a car, and maybe they'll charge them 9%. And over time, that person pays that money back to the bank. And then they loan it out again to somebody who wants to buy a home, and maybe they're charging them 7%. And this homeowner is paying this back over time or through the sale of the home back to the bank. And then they loan it out again, maybe to a builder or a contractor who is doing a remodel or a new construction. And they're charging this contractor 12%. And this contractor is paying it back to the bank. And then they loan it out again. Maybe this time it's to somebody who has debt that they would like to consolidate. And they're charging them 8%. And this person is paying back the bank over time. Okay. So in this situation, if you look at this, for example, with the car, they charge the car loan end of customer, they charge them 9%, but they're paying you 4%. So they've made a spread of 5% there. Then with the home, they've made a 3% spread. With the builder, they made an 8% spread. And then with the debt consolidation customer, they've made 4%. So in total, the bank has made a spread of 20% off of your money. Now, you've only made 4% off of your money, but the bank has made 20%, which is 5 times as much as you've made, or 500% is what they've made on their money. Now, if you look this up, you will find that every single bank in the United States makes on anyone's dollar that sits in their bank, they make between 400 and 1,300% off of every dollar that they keep in their bank every single year, because they're constantly keeping money in motion. That is the only way to make money, is you have to keep it moving. It's got to keep going, and the bank is not going to just let it sit in a vault. Okay? So what is infinite banking? Well, infinite banking is a system of taking back control of the banking functions in your life. Now, you are never going to 100% get rid of banks, because we're going to need checking accounts to move money through. But when it comes to things like loans and credit, and just actually getting permission to use your money, that's what the infinite banking is about. It is about taking back control of those functions that are in your life. And for today, the best, most efficient way that this can be done is through the use of a whole life insurance policy that is specially designed and engineered. Now, I'm going to say that again. This is a whole life insurance policy that must be specially designed and engineered. It is not your garden variety, buy it off the shelf whole life policy. So before you start throwing up your hands and saying, nope, I'm done. I've heard about these whole life policies. They're horrible. I don't want anything to do with them. I get it. I want to say right now that in the United States, as of today, there are a little over 700 insurance companies that sell whole life insurance policies. And of those 700 companies, there are only about 10 that do these specially designed and engineered policies that are specific for infinite banking. Okay. So we are only talking about the policies that come from those 10 companies. So what makes them unique versus standard whole life policies? Well, first of all, these specially designed and engineered policies provide immediate high cash value. So the difference is that with a standard whole life policy, when you pay money into the policy, you don't see any of your money for pretty much the first 3 years. You get nothing out of it. You're just paying money into this policy, and it's to build the death benefit, and you don't see any of your cash. Well, with these specially designed policies, what happens is that you get your money immediately within the first 30 days, or whenever your check clears. You will start to see most of your money in the policy, anywhere from 60 to 90% of your money in the first year, and it grows thereafter. Okay. Also, these policies have guaranteed uninterrupted compounding interest that is contractually baked into your contract. In other words, the insurance company must pay this in interest rate to you year over year, regardless of how the economy is doing or how the stock market is doing. It doesn't matter. They must pay you this interest rate. Plus, every year, they will pay you an unguaranteed dividend every single year. Okay. Now, the brokerage that I work with only works with 5 of the 10 companies that I'm talking about. And of those 5 companies, the youngest one has been in business for over 120 years. And the oldest one has been in business for over 180 years. And of all 5 of them, they have never missed a single dividend payment ever in the history of their companies. And that includes during the Great Depression, during the Great Recession of 2008, during COVID, during every recession that has ever existed. They have never missed a dividend payment. So even though the dividend portion is not guaranteed, you can pretty much expect that you're probably going to be getting your dividend year over year. Okay, that is something that is not guaranteed with every single insurance company. Okay, now the money that you put in has already been taxed. It was your money after your paycheck or whatever, and now you're putting it into the policy. But also, whenever the money grows, it grows tax free or tax deferred, really is the way to put it. But it's tax free as long as you never withdraw the money out early. Okay. Now, I'm going to demonstrate to you later why withdrawing is a bad idea, but taking a loan against it is a phenomenal idea. And I will demonstrate why that is here soon. But as long as you never withdraw it early, it's tax free. And the death benefit that pays out to your heirs after you die is tax free to your heirs as well. Now, these policies come from mutually owned insurance companies. Now, what does that mean? That means that you, the policy owner, are part owner of the insurance company, which means that the insurance company has a vested interest in making sure that you, the owner, are taken care of. So that is why you receive a dividend payment. Okay. They they have an interest to make sure that the owners are happy and satisfied with the products that they receive. You're not going to get that in stock owned insurance companies. These policies are protected from liens and creditors in most states. For example, in Georgia, that it's protected because it's private, so creditors can't come to you and demand your money out of your policy. They can't do it. Also, it provides a death benefit. Now, we know that all whole life insurance policies, really all life insurance policies in general, provide a death benefit. But what makes whole life unique is that there's also a cash value side to it as well. And lastly, here's the big one. These policies, the insurance agent gives up between 60 and 90% of the commission that they make in order for you to have one of these type of policies. Now, why do I say that? That is because I'm going to give you an example. If you have a standard garden variety whole life policy that you get at any company like Prudential or State Farm or wherever, whatever premium payment you put in there goes to what is called the base. And the base is where the agent makes their high commission. And they usually charge about 55% of the money that you put into the base. They get 55% of that, just about. Okay. So with these policies, because you are having high early cash value, only a small percentage of your money is going to the base. And so The agent is giving up between 60 and 90% of their commission in order for you to have this policy. Somebody has to give something up for the other one to get something in return. Okay. So these whole life policies, there's two sides to them. All right. One side is the cash value, and this is the money that you have access to immediately that you can use to invest, to pay off debt, to pay expenses, whatever you need to do. And it's built over time through making premium deposits into the policy. Notice I said deposit and not payment. This is a big difference here. With whole life, well, actually, let's talk about with like car insurance or flood insurance or fire insurance or even term life insurance. Whenever you pay money into these insurance policies, you are literally making a payment into the policy, and it's money that you personally will never see again unless you happen to file a claim, right? Well, with whole life, it's different. You are making a deposit into the policy. And what it is doing is it is building not only the death benefit, but it is a savings account that grows uninterrupted compounding interest plus dividends over time. And you have access to this money. And so you can do things like make policy loans and pull the money out if you need to for paying things down or investing. And so it is built through not only your premium payments, but also through the guaranteed interest that it earns, as well as the annual dividends. Now, there's another side, and that's the death benefit, which we all are aware of. But some of the cool things about the death benefit is that when you die, your beneficiaries that you have designated gets paid the death benefit amount tax-free. Also, a lot of these policies, you can set them up with accelerated death benefits, which gives you access to the death benefit up to a certain percentage while you're alive to deal with situations like chronic, critical, and terminal illness, which is a great benefit to have for later in life or when something tragic happens. So let's talk about policy loans for a minute. I'm going to demonstrate to you why doing a policy loan is so much better than withdrawing your money. Okay. So I want to mention, well, actually, let's do this. Let me show you this. All right. So here's a whole life insurance policy. Okay. You have a cash value. Let's say this policy has a cash value currently of $100,000, and the death benefit is currently $500,000. All right. Now, if you were to do a policy loan, you were to borrow money, you would think that you are pulling, excuse me, you would think that you're pulling $10,000 out of your cash value for this policy loan, right? Well, that seems logical. And the reason it seems logical is because that's the way it works with every other type of savings or investment account that we have. If you were to do a loan against your 401k or 403b, you would actually be pulling money out of that account to use it for whatever you need. So the account would reduce by that amount. It would also happen if you pulled it out of your savings account. You know, it's just kind of the standard way that it works. Well, here's what's unique. This isn't how the way it works. This right here is actually how the way it works. What happens is when you do a request for, say, $10,000, the insurance company is going to loan you their $10,000, and they're going to hold $10,000 collateral against your death benefit. Now, you notice that your cash value has been untouched here. Your full $100,000 is still sitting in there earning uninterrupted compounding interest and dividends while you have this loan out. Yes. So there's some other cool features about this, but effectively what's happening is your dollar that you've borrowed is working for you twice. It is working for you in the policy because it is uninterrupted. It is not being touched. It is still growing. Meanwhile, you're using that same dollar to make a purchase or investment that you took that money out for. Okay. So there's other things about these loans that are great. First of all, these loans will not be denied. It's not like going to the bank and filling out an application, paying application fees, waiting 30, 60 days for the bank to run your credit and decide whether or not they want to even give you the money. No, there's no lengthy application process. As a matter of fact, you'll receive your money within 5 to 7 business days. No questions asked. They're not going to ask you what you're doing with the money. None of that. Also, loans are not required to be repaid while you're alive. They're not going to give you any terms. When you put in a request for a loan, they're just going to give you the money, and they're going to ask you what bank account you want to put it in. You decide what the terms of the loan repayment are. If you want to do it pay back monthly, how much you want to pay back monthly, and how long you want to pay yourself back. If you want to defer the loan for a few months because you can't afford it right now, that's fine. If you never pay it back, that is okay, because they've held part of your death benefit as collateral. So when you die, if you have not paid the loan back, they will just deduct it from your death benefit and your beneficiary will receive the balance. Okay? There is no impact to your credit score because this is a private transaction between you and the insurance company. They are not going to run your credit. They're not going to have any type of creditor or any company coming to knock on your door asking if you're going to pay the loan back. They're not going to affect your credit. And the interest is potentially tax deductible, and that depends on what you're using it for. There are certain investments that you could put money into, and please realize that I am not a tax attorney, so don't take this as tax advice. But you need to talk to your own tax attorney if it's something you want to do. But from the way I'm to understand it, is that you can invest in like oil, gas, real estate, and you could get some tax deductions there off of the interest from the loan. And if you have a business and you're borrowing from the policy for business expenses, that can also be tax deductible. Okay. Pretty cool product. So this banking system has been around for many, many years. And I'm going to show you that there are a lot of wealthy people that have been doing this for a long, long time. Okay. First of all, this guy right here, Ray Kroc, he had a whole life insurance policy that he took loans against to buy real estate to build McDonald's restaurants at the beginning of his company. And he used his whole life policy to pay for those purchases. This lady right here, Doris Christopher, back in the 1980s, she used her whole life policy to do she took loans against it for the startup costs to build what has been known as Pampered Chef. And I'm sure that you're aware that Warren Buffett's company bought her out for, I believe it was over $1 billion at this point. So she did pretty good off her whole life policy. This gentleman right here, if you really look at his name, it makes perfect sense. James C. Penney, the owner of J.C. Penney. So back during the Great Depression, he took loans against his whole life policy to pay his employees so that they wouldn't lose their jobs. And he kept his business intact by the use of his policy. This guy right here, you obviously know who this is. He took loans against his whole life insurance policy to build Disneyland Park. Jim Harbaugh, who is now the head coach of, I believe, San Diego. Well, when he was the head coach for Michigan, during the year that they won the national championship, the University of Michigan used a whole life policy to pay his salary. Okay, so even the universities are using this. All right. Politicians, Senator John McCain, President Joe Biden, even our sitting president right now, all of them, not all of them, but a lot of them have started their campaigns using whole life insurance policies by taking loans against them. And it just goes on and on. But there's one particular individual or family that I'd like to zero in right now. And that's on this guy right here, John D. Rockefeller. So everybody knows who he was, the Rockefeller family. John D. Rockefeller was an oil tycoon. And what he did is he opened a family trust, okay? And he had a whole life insurance policy. And what he did is he set this family trust up with rules. And excuse me, one of the rules is that the trust would own his whole life policy so that when he died, the death benefit would pay into the family trust. Now, in order for his 4 kids to have access to this money, what he had was another rule in place that they themselves each had to have a whole life insurance policy on each of them owned by the family trust so that they could benefit from the family trust. And at any time, if any one of them wanted to borrow money against their own policy, they would go to the board of trustees and they would request a loan. Now, they couldn't be denied because it was against their own policy. But eventually, as they were starting to die off, their death benefit would also pay into the family trust. So it's building a dynasty, a legacy. Now, there's another rule that they had in place. Any person born into the family thereafter would also have to have a whole life policy opened on them they were legally able to do so. And this went on and on. And so the Rockefeller family is still wealthy to this day. Now, if you know about the Vanderbilt family, they squandered all of their money within 3 generations because they didn't follow this plan. This plan was really smart. Okay, it's called the Rockefeller waterfall method. It's something you ought to read up on. It's very interesting. And so there's a family tree of the Rockefeller family. There's more than Winthrop and John D. the fourth, but I just wanted to show them there. But they've been wealthy ever since John D. Rockefeller got the trust started. There's another wealthy entity that uses whole life insurance policies. And I'd like for you to take the time to Google BOLI, B-O-L-I, which stands for Bank-Owned Life Insurance. And what you're going to find is that banks purchase whole life insurance policies on their executives and key personnel, and they build their capital and wealth off of whole life insurance policies. As a matter of fact, banks have more wealth in whole life insurance policies than they have in banks and real estate locations combined. Now, I did my own research just yesterday, as a matter of fact. I was thinking, every time you go into a bank branch, there's always at least one person that works in there that is a vice president. Have you ever noticed that? I have. And so I looked it up and I found that the average bank, 30% of their entire staff, company-wide, are at least vice presidents. Now, why is that? It is because in order to open a whole life insurance policy, you have to have an insurable interest in the person that is insured. So what these banks do is they open a whole life policy on their president, their CEO, their vice presidents, their controllers, their attorneys, all of the key personnel they have. They open a whole life insurance policy on that individual so that if they ever die while they're employed there, the bank is made whole and they're able to, they make money off of the death of this employee, which is pretty demented if you think about it, but it also makes them whole while they're trying to find a replacement executive or employee. So they are just that there, if 30% of their employees are vice presidents or better, they're geniusly turning about a third of their staff into executives, notice in quotations, so that they can legally and contractually be able to open a whole life policy on these people so that they make a whole lot more money. Okay. Now, there is a gentleman by the name of Chris Naugle. I invite you to look him up on YouTube. It's his channel is Chris Naugle. He is a really cool guy. He is a IBC practitioner. Actually, I'm not sure if he's a practitioner, but he is highly engaged in infinite banking. And he is quoted as saying that cost is only an issue in the absence of value. No one wants to buy anything, but everyone wants what whole life insurance provides. And he's absolutely right. You know, everything that whole life insurance provides, we're all like, would love to have that. But the problem is we've been stuck in the stigma thinking that whole life insurance is terrible, that, you know, that it is a horrible place to put your money. Well, I've demonstrated for you up until now why these specially designed and engineered policies are actually very unique and very cool for doing private banking. You can't do this through a standard whole life insurance policy. Well, you probably could, but it would take years. And no, who's got time for that, right? We all want our money now. We all want to put it to work right now. So I want to ask you a question and think about this. All right. Let's say that when you're playing Monopoly, okay, and you start working your way around the board, is it possible for you to win the game of Monopoly against your opponents without purchasing any of these boxes, without buying anything? And the only thing you do is just pass go and collect $200. Is it possible to win the game? The answer is most likely no. You're not going to win the game because everybody else is buying up properties. And every time you land on a box, you're paying somebody rent and you're paying expenses. And that $200 is going to run out pretty quick, right? So everything, I want you to look at this board. Every box that you see there is an opportunity, okay? And imagine passing go is when you collect $200, that is just the interest and dividend payment that you're receiving. Okay. So you want to keep your money in motion, just like the bank does, right? And you want to do that through opportunities. So let's talk about an opportunity, and that is the purchase of a car. All right. So I'm going to set this up for you because I think this is important to say this as we dig into this. I would say 98% of people probably buy cars this way. All right. Let's say you're sitting at home and you've decided, you know, I can't stand my car that I've got now. I hate it. It keeps breaking down. I'm done with it. I need a new car. And you're like, I don't have any money in my savings account to buy one. So I'm going to have to go to the car dealership and just finance a car. Okay. And I would say that most people probably sit down and they take a look at their budget and they've come up with some monthly payment that they feel like they can afford. And they've also maybe thought through how many years that they're willing to make that payment for. Okay. And let's say that you've decided that you could afford $650 a month and you're not willing to go any longer than maybe 5 years. Okay. And you've made that mind up at your mind up at the house. Okay. So now you have baked that into your budget. You've made your mind up that you are now going to spend $650 a month for 5 years. Okay. It's now baked into your budget. So you get into your junky car and you head on over to somewhere like, I don't know, let's say CarMax. We'll use them as an example. Okay. And you go to CarMax and you walk around the lot and you happen to find a car that you like and you're interested in buying that car. Okay. So you sit down with their finance department and the price tag on the car is $30,000. And the finance department says, all right, here's what we can do. We can charge you 9% interest and we will give you a loan for 60 months. You can finance this car for 60 months at 9%, and you will pay us back at $622.75 per month. Okay. And you're like, great, that falls within my budget. That's what I had planned. Okay. Now, if you went with their bank to do this, over 5 years, after you've paid the car off, you will have paid back to them, their bank, $37,365. Okay? All right. Well, instead of doing that, what do you say that we use our bank to buy this car? Okay? And so what we're going to do is, let's say you have a whole life insurance policy that you have been making annually. You have been making $3,000 premium deposits into this policy over time, and you've built up $31,970 of cash value in this policy. And note that it says that the annual growth, the dividend crediting rate that you're getting on this policy year over year is about 5.75%. It's growing at that compounding rate year over year. Okay. So here's what we're going to do. We're going to use our bank to buy this car. And what you would do is you will go to the insurance company and take out a $30,000 policy loan. Now, remember, I told you that when you take a loan against your policy, does it come out of your cash value? No, it does not. You are borrowing the $30,000 from the insurance company's money. They are loaning it to you. So your $31,970 is still in the policy, still growing, uninterrupted, compounding interest plus dividends. Okay. But I do want to say that when you take a policy loan, yes, you absolutely pay interest back to the insurance company. Okay. And in this case, let's say that they are charging you 6.75% interest for this $30,000 loan. Okay. Let's stop right there because I know what you're thinking. You're thinking, why in the world would I take a loan at 6.75% interest when my money's only growing at 5.75% interest? Why would I do that? Okay. Here's my answer. Go back to the slide where I showed you the vacation dilemma. Remember that? Remember that your 10,000 was sitting in there growing at 4%, but they loaned you the 10,000 at 6% and you still made more money? It's the same scenario here. Your money is going to grow faster than you will pay the insurance company back. I want to make that clear. That is very important. So this interest rate being a percentage point higher is non-incidental. I'm sorry. Okay. So you take out this $30,000 loan and you drop it into your checking account. And then you head to the dealership and you buy the car for $30,000. All right. Now you've purchased the car. You have the title. The title is in your hand. This is your car. Now, I would say that probably 98% of the population would stop here. They'd be like, great, I got a car. And you'd feel like you were done. Okay. But we're not going to do that. We are not going to do that because we are our own bank, right? So I want to ask you this. Imagine that you owned a brick and mortar bank building and you were the manager of that building and you took $30,000 out of your bank. Would you not pay your bank back? You were going to pay CarMax's bank month over month at $622.75 each month for 5 years at 9% interest. You were going to pay their bank back over 5 years, but you're not going to pay your bank back over 5 years? Is their bank, is their money more important to you than you and your money? I would hope not. Are you going to steal from your bank? No. Why would you do that? That is where people get hung up, is they think that because they've saved up the money and now they've spent it, they don't have to do anything. Well, I'm going to show you right now why paying yourself back is a wonderful thing. And this is going to blow your mind, okay? So what we're going to do is we're not going to stop here. And what we're going to do is what's called a recycle and recapture. And you are going to be an honest banker. So every single month, you are going to pay yourself back at $622.75 a month at 9% interest into your segregated bank account. And from there, you're going to pay the policy loan back every single month over 5 years. All right? Now, here's what happens. All right? Over 5 years, you will have paid the policy loan off at $34,748. Remember, if you paid their bank, you were paying, it was $37,000 and change for the car. Here you've only paid $34,748. Now, here's another thing to note. You've noticed that you've paid yourself back at interest, at 9% interest, as a matter of fact, but you only owed the insurance company 6.75% interest, right? So that means at the end of 5 years, there's going to be a little bit of money left over, is there not? Yes, absolutely. And so that little bit of money is $2,617. And what you're going to do with that leftover money is make an additional premium deposit into your cash value to add to the cash value. So not only has that been added to the cash value, but over 5 years, your original money has been growing uninterrupted, has it not? Yes, it has. And it has now grown to $58,335. And you now have a car, okay? And you've made a spread, just like the bank has. You've made a spread where you saved 9% because you didn't pay the car dealership 9%. You paid yourself 9%, minus the 6.75% that you paid the insurance company, plus the 5.75% growth that your original money made in the policy. You made an 8% spread on your money simply by having purchased and recycled and recaptured the money for this car purchase. It's pretty cool. So how much did you actually pay for the car? All right. If you remember, the price tag was $30,000. And the cost at their bank was $37,365. But since you chose to use your bank, you only paid $34,748. So you've saved $2,617. And the growth of your cash value over 5 years was $26,365. And so in total, you paid $0 for this car. Now you're probably looking at the screen right now going, huh? How did I pay $0 for the car? All right, so let's look at it mathematically. All right. Here is the policy. Okay. And in this particular policy, let's say it took 10 years to build up $30,000 of cash value in this policy. Okay. So starting in policy in year number 11, you can see that the actual cash value is $36,276. And you are putting in $3,000 premium deposits every year to build this policy. So what you do is you take a $30,000 loan out. And you can see that the cash value available to borrow has dropped by that amount. I hope you see that there. Now, every year, you're going to make the $622 a month payments, which comes to $7,473 for the next 5 years. Okay? Now, if you look here, you can see in the cash value available to borrow at year 15, that amount, $58,335, is now higher than the actual cash value of the original cash value of $55,718. So let's look at the math here. Okay. If you were to add up all of those $3,000 premium payments over that 5 years, plus those $7,473 loan repayments over 5 years, you add those together, minus the $30,000 that you took out of the policy, you have a net injection of capital into your system of $22,365. Are you with me? I hope so. Okay. You physically come out of pocket over 5 years, $22,365. All right. Meanwhile, your cash value has grown $26,365. So that means that you have recycled and recaptured $1.18 for every dollar that you spent out of your pocket when purchasing this car. It is pretty cool. And if you implement this system, this will be the case not only for cars, but if you need to buy a new HVAC unit for your home, if you need a new roof on your home, you need to remodel, vacations, whatever, if you do a full circle, recycle, and recapture of your money, you will always recoup the money that you've put in there, and it potentially will grow on top of that. Okay? So the other thing I want to mention is that the reason whole life insurance is the vehicle that we're using to do infinite banking is because it is the most efficient way to store your money. You could do infinite banking with a savings account, with a 401k, with a 403b, with a CD account, a money market account. You could do infinite banking with different vehicles of wealth building, but the most efficient way is with a whole life policy. And because the whole life policy lets you keep your money in the account while you're borrowing against it, it is the only vehicle that permits that. So that is how you're able to get all of your money back when you pay yourself back as an honest banker. Okay? So there are rules of wealth. I love that gift that I put together of my wife and I. The rule number one is pay yourself first. You know, we've always we're taught that we should pay all of our bills first, and then we pay ourselves last with whatever's left over. Well, that's the wrong way to think. You've earned this money. Pay yourself first, and then pay everybody else. If you think about making premium deposits into a policy because you have immediate access to your money, it should be the first priority that you pay, because if you can't afford something else to pay bills, you can just take it out of the policy. You haven't lost anything. It should be priority number one. Another rule is pay yourself an interest. Grow your wealth. And figure out what interest rate works for you, but pay yourself back. And you want to always recycle and recapture your money. Don't stop at pulling the money out and buying the car and then just leaving it like that. You're cheating your bank. You're stealing from your bank, and your bank is going to go insolvent before you know it. Okay, so be an honest banker. Now, there are other things that you can do with this money. Let's say after you've got paid off your debts, you could do private lending. You know, Let's say that there's a person who flips houses and they need to borrow $50,000 for a renovation, and you happen to have $50,000 sitting in your policy. Well, you could turn around and loan $50,000 out to this individual and charge them 12% interest. And they're going to, and let's say in this situation, they pay you back over 12 months and they're going to pay you $4,442 a month over the next 12 months at 12% interest, and you get all your money back in 12 months. Well, now you've paid back the policy loan at 51,846.92. You've made a profit of 1462.45 just off of their loan repayments, and that increases your cash value over 12 months. You've made a 10.5% spread, and your total profit is $4,087.45. And this is investing. And that's how you keep your money moving. You want to keep it moving constantly. Don't let it sit. And opportunities include debt consolidation, paying off debts. That is the fastest way to wealth, is through your own debt and expenses. That is the fastest way. So you don't have to invest. You could just pay off all of your debts using infinite banking. So I'm going to wrap this up by answering a very common question, and that is, am I stuck paying premiums for the rest of my life on these policies? I hear that I'm going to have to pay forever. Well, the answer is no. As a matter of fact, I'm going to show you what your options are, and we're going to start with the worst option, and we're going to go to the best option. Okay? So the worst option that you have, if you don't want to pay premiums anymore on a policy, you're sick of paying them, is you can surrender the policy. You can call the insurance company up and you can say, hey, I don't want to make premium payments anymore. As a matter of fact, I hate this policy. I don't want anything to do with it anymore. I just want to close the policy. I'm sick of paying on it. The insurance company, what are they going to do? Well, first of all, you will owe no more premiums on the policy when you surrender it. They are going to write you a check, and it's going to be for the full net cash value that you have built up in the policy at that time, minus any outstanding policy loans that you may have. Whatever that net is, that's how much money they're going to pay you. The policy is fully canceled when you do this. And once you're out, you are out. That's it. And just remember that when you surrender the policy, whatever growth that was made in the cash value, because you've now been withdrawn your money out of it and closed the policy, the growth of it becomes a taxable event. Okay? That's the worst option. That's not bad, right? I mean, you have the freedom to just end the policy. You're not contractually bound to pay this for the rest of your life if you don't want to. If you don't want to do it anymore, close the policy and they'll write you a check. The next option is what's called a reduced paid up option. So the way this works is that they take your death benefit and let's say you call them up and you're like, look, I don't want to close the policy, but I don't want to make any more premium payments ever again. And so this option here, what they will do is they'll take your death benefit and they will greatly reduce the death benefit down to the point that they say, okay, now the policy is fully paid up. And whenever they get it to that point, that means that you no longer have to make any more premium payments because they've reduced the death benefit down to the level that your cash value equally has satisfied what's needed to be satisfied, if that makes sense. Now, one of the negatives about this is you can't do this option in the first 7 years of the policy. And the reason is, if you do that, and I'm not going to get into the nuts and bolts of this, but it will initiate what's called a MEC, which is a modified endowment contract, and that triggers the IRS to start making this policy a taxable, potentially taxable policy. So you can't do it in the first 7 years unless you're ready to suffer tax consequences. Once you make a decision to do this, you can't reverse it. It's done. Okay. So once you've reduced paid up, that's it. Third option is a withdrawal of your money. And what do I mean by that? If you don't want to, let's say that you have a premium payment coming up and you don't have the money and you don't want to pay it, what you could do is you could physically withdraw money out of your cash value, turn right back around and pay the premium back into the policy. Okay. It sounds like funky math, but you really can do that. And so what this does is it kind of defers out your need to make a premium payment and you haven't come out of pocket for anything. There is a option that you can have it automatically set up where the insurance company can do what's called a dividend premium payment option. And that's where you can set up that year over year that the dividends that you receive every year automatically is used to pay the minimum premium that is required for the year. You could set it up to do it that way. Now, if you do this through a withdrawal or the dividend premium payment option, your growth is going to be moderately slowed. And it's because you're taking money out and then putting it back in instead of adding new money. Okay. And there's potential tax liabilities with this as well. And that really comes down to how much are you actually withdrawing. Okay. Another option is what's called making a minimum payment. So let's say that you have set it up to where you are paying annually. All right. Every year you pay one time. Well, maybe this year you can't afford the annual payment. Well, you can change your premium payment mode to maybe, first of all, you could pay just the minimum, right? So maybe you've been paying the maximum that you're allowed to pay into the policy. Well, now maybe you can afford just the minimum for this year, the base premium. So you could do that. Another option is you change the premium mode where instead of paying annually, switch to monthly. And those lower payments, maybe spreading it out over time might be a little easier for you. Now, the growth may be slowed here as well, because if you pay annually, the growth moves a little quicker than paying monthly. Okay. The good news about this is if you do it this way, the policy is still in force, right? Nothing's affected. You're still making your payments and everything's growing the way it should be growing, and all's well. And here is the really the best option, okay? And that is taking a policy loan to pay your premium. Is a cool way of doing that. So what you're doing is you're taking a loan against the policy to pay the premium for the year, and then you pay that back over time, or you can defer it and pay it later, whatever. You're the banker. You control the terms. You control when you pay it back. So it's up to you, but you are in control of the money here. There's loan flexibility because of that, right? And the growth remains the same, mostly. Okay. So because you are, here's an example. Let's say you have 100,000 in there, and this year you owe $10,000 of a premium payment. You can take a $10,000 loan, pay the premium payment. Now your cash value has grown to 110,000, but you have a $10,000 loan sitting out there. So because the loan's sitting out there and it's accumulating interest, that can eat away at your growth if you're not paying that interest and at least keeping that serviced. All right. There's also a option that you can have the insurance company set up what's called a policy premium loan option. And that is if for any reason you just can't make payments, you can set it up so the insurance company will automatically do a policy loan from your cash value to pay the minimum premium payment for the year just to get you through, just so the policy doesn't lapse and you don't lose it. So in all, I just want to say that you will not lose your money. You can't lose your money. If you, even if you let the policy lapse and it's not active anymore, they're going to pay you all of your cash value back minus the any outstanding loans. So you're good to go here. All right. So I want to wrap it up and just say that this is a wonderful thing. And it's something that we've put into place. And we are already working, taking policy loans against our money to pay down student debt and to help Olivia with her business. And it has been fantastic. It frees up so much and you're able to grow wealth so fast. So if this is something that you would like to explore and talk about further, please reach out to me. If it is something you want to go forward with, I would be the guy that you would come to, and I will help walk side by side with you through the process, and I will get you connected with the right people to make this work. So I hope that this was informative, and I hope it was entertaining, and I appreciate you taking the time to join me today, and we will talk with you soon. So have a great weekend and the rest of the holidays, and we will see you soon.